Okay, I think we'll kick off. So you're all very welcome today to our webinar on the workforce management issues that are topical at the moment. We've a collection of colleagues here today to chat you through a couple of items, all from the Employer Solutions team, the Employment Tax team, and our People and Change team as well. So we'll take you through, as I said, a couple of topical issues. Just one item, if you any questions going through the webinar, feel free to pop your questions into the Q&A at the bottom of the screen. So any questions we'll take at the end. The session is being recorded just to make you aware as well. So to kick off, I'm just going to take you through the first item on the agenda, and that is the wage subsidy support schemes. So my name is Michelle Dunn, and I'll take you through the TWSS element. My colleague Amy Adams, who works in our payroll team, will take you through the EWSS. Okay. So the temporary wage subsidy scheme was in place from March until August 2020. Although there's no subsidies being paid out of this scheme at the moment, we are still dealing with a couple of items that are a legacy from that particular scheme. So the wage subsidy, the temporary wage subsidy support scheme, it paid out roughly 854 million it cost to the Exchequer. There was roughly 660,000 employees who benefited from the scheme and 66,000 employers. So a very valuable benefit and resource for employers, and employers certainly made use of that particular scheme when it was available. We've now transitioned to the employment wage subsidy support scheme, and as I said, Amy Adams, my colleague there, will take you through the details of that, and that commenced with effect from the 1st of September 2020. The TWSS reconciliation is one of the items currently ongoing, and that we're certainly seeing a lot of interest from employers on. Now, we conducted a webinar with Revenue last week. The recording of that is available, and Revenue took us through a detailed comprehensive analysis on the TWSS reconciliation process. So if you're coming across any difficulties with this reconciliation, you're getting maybe error messages, or perhaps the reconciliation isn't available to you yet, I would certainly encourage you to watch the update from Revenue on that webinar from last week. So just to recap, the reconciliation process for the TWSS refers to the first phase of the TWSS scheme, what's known as the transitional phase. So really the scheme was launched very quickly. It was there obviously to support employers through the initial stages of the pandemic. At the initial stage, the transitional phase, Revenue paid out €410 per employee to the employer. Now, that may not have been the subsidy that was due to be paid to the employee. It could have been an amount that was lower, and the employer was required to calculate the subsidy paid to the employee, but Revenue paid them 410 so that there would be funds in the bank to pay out the subsidy. So there's a mismatch between the amount the employer received from Revenue and what was paid out to the employee, and possibly there is a refund due from the employer back to Revenue. The first stage of the reconciliation process required the employer to provide details to Revenue with respect to what they paid out to the employee. So Revenue took that information, reconcile that against what they actually paid to the employer, and have provided that reconciliation via the ROS system. So on the ROS system, what should be available to you is that reconciliation identifying what is due to be paid back to Revenue. And certainly we would encourage employers to take a look at that information and run through the details and make sure they're happy with the information contained in it. Apologies, the slides have just stuck there. Amy, if you're online, you might just flick on for me. Thanks. So where employers at the moment, they should take a look at that ROS system, decide if they're happy with the information, the reconciliation produced by Revenue, and if there's any adjustments, they feel it is warranted, contact Revenue and engage with Revenue on making those adjustments. There's a deadline of the 30th of June 2021 to accept that reconciliation. So if you need to make adjustments, do so timely and do so before the 30th of June. There's no indication that that date is going to be moved. Revenue want to clear this part of the TWSS up and have the reconciliations approved and accepted so they can move forward with the schemes currently in place. Just to make you aware as well, if you do owe an amount through the reconciliation, so if the employer does owe an amount back to Revenue, there is an ability to warehouse that debt. So the debt warehousing scheme is available to employers whereby they can warehouse debt, VAT and PAYE liabilities. So if you have from the reconciliation amount that is due to Revenue, you can warehouse that amount if you qualify for that particular scheme and park that debt for a period of up to 12 months. There's some information available on Revenue's website, and there's just a link down there at the bottom of our slides on that. And as I said, if you're facing any difficulties, please refer to the webinar with Revenue last week where they went through that reconciliation process in detail. So another item that is currently in the minds of individuals at the moment will be the tax liability with respect to the TWSS payment. So any PAYE that was due to be collected from the TWSS payments was parked. So the employer didn't have to operate PAYE on the TWSS amounts. So it's up to the Revenue will be collecting that amount from the employee directly. Now, most employees will have received their preliminary end of year statement for 2020. That will show an under or overpayment or a balancing amount of tax. For anyone who was in receipt of the TWSS payments, they will more than likely have a tax liability to pay. There's three options with respect to the payment of that liability. The first is that in most cases, Revenue will default to collecting the tax liability over a 4-year period through adjustment of tax bands and tax credits, and that will begin in January 2022. So to give you a rough idea, if there's a liability of €1,000 that the employee is due to pay, there will roughly be a reduction of €20 per month in their net take-home pay as a result of Revenue collecting that €1,000 over a 4-year period. The second option is the employee can pay a lump sum, so they can pay an amount towards that tax liability and the remainder being collected through the tax credit system, or they can pay the balance in full and just clear out the tax liability. So they'll have no adjustments to their tax credits down the road. A third option that has come out from Revenue is with regard to a concession available, a benefit in kind concession. So the employer can pay the tax liability on behalf of the employee, and there'd be no tax liability or benefit in kind liability arising. That particular liability, that particular concession, the details that we're working from at the moment are those published on Revenue's website. We're waiting on further guidance from Revenue with respect to this concession. It was due to be launched towards the end of March, and unfortunately we're still waiting on that. We were hoping to have it by now, and Revenue are just saying that's going to be available in the near future at the moment. Unfortunately, there's no commitment on a delivery date on that as yet. So the current state of play, just in terms of the BIK concession on the payment of TWSS tax liabilities, is that the deadline for payment of the tax liabilities by the employer to Revenue, if they want to avail of the concession, is the 30th of June 2021. So the payment must be made by that date. Now, we are expecting that to be extended because of the delay with the guidance. So we wait to hear from Revenue when the guidance is introduced and whether that 30th of June deadline is extended to later in the year. There are some, I suppose, issues with respect to calculating the TWSS tax liabilities, and this is the reason we're waiting on the guidance and why there has been a push for guidance from Revenue on this. It's very difficult to quantify the amount of the liability due. How is that done? Revenue have indicated that you look to the preliminary end of year statement. That's a personal statement by the employee. The employee may not want to share it with the employer. There may be other sensitive information on it, perhaps relating to a spouse or somebody that they're jointly assessed with. And as I said, they may not want to share that with Revenue. So it's very difficult to quantify. We're hoping that the guidance will answer a lot of the questions that are floating around with respect to this concession. So I'll just hand over to Amy now, who'll discuss the EWSS wage subsidy scheme.
Thanks, Michelle. Good morning, everybody. My name is Amy Adams. I am one of the managers on our outsourced payroll team. And this morning, I'm just going to talk you through the employment wage subsidy scheme and where we're currently at with it. So we're going to first look at how you qualify in 2021. And the reason for this is that the qualifying period that you look at for eligibility is slightly different than it was when it was first introduced in 2020. So for 2021, you assess your eligibility based on a 30% decline in turnover or customer orders in the period 1 January 2021 to 30 June 2021 compared to the same period in 2019. You will need your projections and your calculations, and you will need to have documentation and evidence supporting your projections. It may be a case that using turnover or customer orders isn't appropriate for your type of business. And if that is the case, an alternative reasonable basis should be used to see whether or not you're eligible. Where you are using an alternative basis, you should seek revenue guidance on this. And this is just to avoid any issues down the line in terms of any compliance checks or anything like that. Special rules do apply where the business commenced after the 1st of January 2019 because you wouldn't have a full qualifying period to compare it to, and full guidance on that can be seen in the revenue guidance. One criteria is that you must have tax clearance, and when you try to register for the EWSS on Revenue's online system, ROS, if you don't have that tax clearance in place, you won't be able to proceed with the registration. So it's something to make sure that you do have in place before you continue with your registration. If you do satisfy all of the conditions for 2021 and you want to go ahead and claim this subsidy, you must register in advance of the payroll you wish to claim for. So if you process your payroll today, for example, and register tomorrow, you won't receive a subsidy in respect of that payroll that's already submitted. So we would advise that you give 48 hours to allow that registration to go through on revenue side. And then you have to make a claim with each payroll. So typically this is a little tick box with each payroll submission. So every employee will have a little tick box beside them that you'll need to tick before you submit that payroll into revenue. And then you have to continue to review your eligibility on a monthly basis. And this bit is really, really important. You can't just decide at the start of January, yeah, we think we're going to qualify, our turnover should be down for the 30%. It needs to be monitored and reviewed and documented at the end of each month to make sure you continue to be eligible for it. So employers have to retain evidence of this documentation, copies of your projections, and demonstrate this continually over the specified period, so 1 January to 30 June. You also must undertake a review on the last day of every month to ensure that you do continue to qualify for it, and you do need to document that at the end of every month. So for example, you qualified in January, you had expectations that you'd be down your 30% for the full 6 months, and for some reason in March your orders went through the roof and you're no longer under the 30% that it takes to qualify. What you need to do in that case, you need to deregister on ROS straight away for the EWSS from the day following the day of your review, and you need to cease claiming the subsidy. So you need to untick that box for each employee and not claim for that employee. If then subsequently you do qualify again, so April is a really, really bad month and you do your review and you qualify again, you can re-register. The subsidy rates, we'll have a quick look at them, what they are currently. So you'll see on the screen there that anyone earning, any employee earning a gross weekly pay of less than €151.50 or who exceeds €1,462 gross per week aren't entitled to any subsidy. So no subsidy is payable to employer in respect of those gross pays. Where the employees are earning between €151.50 and €1,462, there are a number of different rates payable to the employer. They're listed on the screen and they're tiered depending how much the employee is earning, ranging from €203 to €350 per week to the employer. So we'll have a little look at what's going on with compliance checks. So we are seeing at the moment that Revenue are undertaking risk-based assessments, and they're doing it in real time, and they're reaching out to certain employers looking for information from them. Revenue have said that there may be an assurance check program similar to what we saw on the widespread scale last year with the TWSS at a later stage, but they haven't confirmed this. And they will issue details on how this will operate prior to commencement if it's going to happen. So what we're seeing at the moment, what they're looking for with these real-time risk-based based assessments is a summary of the impact that COVID-19 restrictions have had on your turnover or your business or your customer orders. And they're looking for a detailed explanation and supporting documentation concerning the monthly reviews that are undertaken. So that's why I said these are really important. You need to be making sure you're doing them if you are continuing to avail of the scheme, because revenue will look for evidence that you have been doing this. They're looking for details of any projected and actual turnover to support your entry into the scheme and the continued eligibility for the scheme. And they're also looking for assumptions used to project your turnover figures. So if for any reason you need to pay back the EWSS, so whether revenue have decided that you weren't eligible and they request the amount to be paid back, or you as an employer have decided you weren't eligible and need to repay an amount, there are steps to doing this repayment. So the first thing you need to do is reverse the relevant payroll. So for example, if you have processed your April payroll last month and you had ticked the box for everybody, you need to go back into that payroll, you need to untick the box for each individual that you had claimed subsidy for, and you need to resubmit that to revenue without that marker ticked on your software. Once revenue get that resubmission, they will then recalculate the employer's PRSI liability back to the standard rate, so the 11.05 rather than the 0.5% that you would have got as a result of being claiming the EWSS. And a statement will then issue outlining the amount due, and that is repayable by the employer. Then the actual amount of the EWSS subsidy also needs to be repaid back to revenue, the full amount of the subsidy, and that's done separately to the PRSI payment using revenue's Rev Pay system. And the EWSS box should be selected when you're making this repayment to revenue. So that's all from me today, and thanks very much for your time. I'm going to hand you over to my colleague Joanne now.
Thanks, Amy. Good morning, everyone, and thank you for joining. My name is Joanne Sinnott, and I'm an Associate Director in the Tax Department in Thornton, and I specialise in global mobility and employment tax. So this morning, I will be speaking to you about remote work and Irish and international tax considerations that come with it. As we are all well aware by this stage, remote working is common practice and has been for over a year now. The traditional workplace has changed, and employers need to be aware of any tax obligations that they may have where their staff are working remotely, especially if that remote working place happens to be in another jurisdiction. So there are a number of scenarios for Irish employers and employees when it comes to remote working or working in another country, whether it's due to COVID-19 or whether it's for normal business needs of the organisation. So during the pandemic, Irish employers may have facilitated some of their employees to work remotely in a foreign jurisdiction. And as I said, this may create tax issues for both the employer and the employee. So in terms of tax risks, the first thing I'll mention here is the permanent establishment risk. Where an Irish entity has employees performing their duties outside of Ireland, this may give rise to a corporate tax presence in the foreign jurisdiction and consequently a permanent establishment or PE. If a taxable presence is created in another jurisdiction, the Irish entity may have to comply with the tax reporting obligations of that jurisdiction. Now, guidance from the OECD tells us that working from home because of the COVID-19 crisis shouldn't create new PEs for the employer, and Irish Revenue have also issued similar guidance, which is helpful. However, the foreign tax position should also be considered dependent on the facts of the case. There are also foreign payroll and reporting obligations along with setup costs to consider. Foreign and local reporting obligations can arise for the Irish employer, which can be costly where duties of employment are carried out abroad, and employers may need to comply with the payroll tax reporting requirements of that country as well as in Ireland. Dispensations may be available for the Irish employer regarding the operation of the foreign payroll in that country. However, again, it's important for foreign advice to be obtained. Payroll reporting requirements differ in every country, and the tracking of the working time spent in the foreign jurisdiction is critical in determining whether or not there is actually a reporting requirement for the company. In certain cases, and depending on certain conditions, a PAYE exclusion order may be applied for and obtained from the Irish Revenue, which will allow the Irish company to turn off Irish PAYE and USC, providing, like I said, that other conditions are also met. Social Security also requires consideration, and typically Social Security provisions of the country where the employee is actually carrying out the duties will apply. However, there are EU regulations and bilateral agreements that we can rely on that may make it possible for the employee to remain only in the Irish system and avoid a foreign charge to Social Security. The rules of the case the rules need to be carefully considered, and each case needs to be carefully considered, and there may be a need for a retention certificate from the Irish authorities as well. So again, it's just something that advice needs to be obtained on. The tax resident status and potential tax liabilities for the employee will also need to be considered, as they, depending on the number of days that they spend in another state, they may also trigger personal residence for themselves, which would end up in personal tax filing and reporting obligations that they may not have realised that they would have, and some of their income then will be brought into the scope of the foreign jurisdiction. The tax residency rules are again specific to each jurisdiction, and there may be some force majeure concessions due to the pandemic, and also then where any element of double taxation arises, double tax relief should be available where we have a double tax agreement with that other country as well. So the Irish Revenue introduced a number of concessions in March 2020 to enable and support employers and employees to deal with issues relating to employment taxes and low mobility caused by the pandemic. And a lot of these did end as of 31 December 2020. However, some of them will continue into 2021 and are expected to continue for the duration of the pandemic. The measures that continue to apply on a concessionary basis for 2021 are listed here on the slides, and I'll go through them. And the first that we have mentioned here relates to the residence rules and the force majeure circumstances. Technically, this concession did end on the 31st of December. However, a number of representations have been made to request that this concession is reconsidered for 2021, as we're all aware, public health advice has consistently stated that travel increases the risk of contraction and spread of COVID-19. So in a nutshell, provided certain conditions are met, the concession stated that an individual would not be regarded as being present in the state for residency purposes due to extraordinary natural occurrences that couldn't have been foreseen and avoided. And Revenue confirmed that where a departure from the state is prevented due to COVID-19, that they will consider that this is force majeure when they're considering an individual's tax residence position. Excuse me. There are quite a few things to consider in order for the force majeure conditions to apply in 2020. And namely, the individual must have left or tried to leave Ireland by the 1st of June 2020, or else the concession won't apply, unless they were kept here because of health reasons. Also, the provisions of the concession do not apply to anyone who arrived on or after the 6th of May 2020. As mentioned, Revenue have recently confirmed that the concession will not apply from 1 January 2021. However, we are hopeful that there will be a response to the submissions that have been made in due course. The next concession relates to the transporter workers relief. So guidance states that where employees are required to work from home in Ireland due to COVID-19, such days spent in Ireland will not actually stop an individual from claiming this relief, providing all other conditions of the relief are met. And this concessionary measure will continue to apply for the tax year 2021 as long as they're required to work from home in Ireland due to COVID-19. There were also a number of conditions relating to benefit in kind, and it was confirmed that where COVID-19 testing is performed or arranged by an employer, or where an employer provides a COVID-19 test kit to an employee for self-administration, no BIK charge should arise. A BIK also normally arises where accommodation is made available by the employer for private use. However, where there's temporary accommodation provided by an employer to mitigate any transition of COVID-19, then again, no BIK charge will arise in this situation. And finally, as I touched on before, Irish Revenue have confirmed that they will disregard for corporation tax purposes any presence in the state that is due to travel restrictions related to COVID-19. So, as I mentioned above, a number of these concessions that were introduced for the pandemic did cease as of 31 December 2020. So Revenue had confirmed that foreign employers didn't have to operate Irish PAYE where employees were relocated temporarily to Ireland during COVID-19. However, it is important to note that the individual may still have a personal tax liability in their own capacity. And similarly, with respect to the multi-state workers, a foreign employer could continue to operate Irish payroll based on the established work pattern pre-COVID, where the other conditions were satisfied. However, these measures ceased on the 31st of December. And since the 1 January 2021, employers are required to operate PAYE as normal. And this is obviously subject to any exceptions that were already available under Irish law and guidance. There were a number of extensions given as well in respect to certain filing deadlines during 2020, and this was for SARP applications, PAYE dispensation applications, and share scheme reporting deadlines. This again ended in 2020, and no similar extensions were introduced for 2021. Another concession that happened there was where an employee was seen as integral to the business and was required to return to Ireland to deal with issues relating to the COVID-19 pandemic, as long as costs incurred were reasonable and the employees were not otherwise compensated. No BIK charge arose between March and December 2020, but again, this concession ceased at the end of 2020, and normal provisions will apply from January 21. A number of other employment tax measures are available to assist employers and employees to deal with the impacts of COVID-19, and these include tax relief for e-working and special rules for employees working from home due to COVID-19. So this includes a payment from the employer of $3.20 per day, which can be made tax-free, or where that payment is not made by the employer. Employees are entitled to make a claim in respect of any light and heat and broadband bills, and they can do this through Revenues My Account through a year-end tax return. Benefit in kind exemptions for providing equipment to employees to set up working space in their homes, and on payment of taxi fares for transporting staff due to health and safety concerns were also provided. And there's a special concession to the small benefit exemption of €500 per year, and that's for certain frontline and key employees. There was also specific BIK rules for the provision of company cars for the duration of the COVID-19 pandemic as well. So there are a number of tax implications to consider in respect of remote working abroad, a lot of which I've touched on in the previous slide, such as the potential dual payroll withholding obligations and the operation of foreign payroll. These costs and logistics behind this can often be difficult to implement. Social security and residency status should also be considered, along with any potential force majeure measures relating to the pandemic in each country, and then the impact of that on certain relief that individuals may already be claiming. Local employment law requirements may arise for the Irish employer as well, and working visa requirements should also be considered, especially now with Brexit as well, which conveniently brings me on to my next slide. So along with visa considerations for employers, there is also social security to think about now with Brexit. However, the Social Welfare Order 2020 came into effect from January this year, and it ensures the maintenance of social security rights and entitlements and ensures that these remain the same for Irish and UK citizens, which is very similar to the EU regulations that ensure employees should only pay social security in one country. It's important to note that Brexit has not changed the underlying tax rules in Ireland. However, given the geographic location and the close business relations, we would expect to see an increase in short-term business visits between Ireland and the UK, and this again may have tax implications for the individuals and for the company. So we would encourage employers as well to carry out a review of their workforce and to identify any individuals who may be impacted by immigration restrictions that they wouldn't have been before. So what next? There are plenty of considerations for employers as we continue to navigate the remote working going forward. Many companies may adopt a more hybrid approach, and my colleague Michael will touch on this piece more later on in the presentation. But for now, I would like to take this opportunity to thank you all for joining and for your time, and I'll pass over to my colleague Debbie Fry, who will be speaking about the financial wellness. Thank you.
Thanks, Joanne. So my name's Debbie Fry and I work in our private client department. And this morning I'm going to bring you through the area of financial wellness and why this is an area that both employers and employees are looking at in more detail. I'm also going to touch upon how the corporate benefit landscape has changed over the past few years and why it's important to review both your current offering and bring you through some of the areas of consideration as you review your current benefits. Now, how are you has become somewhat of a loaded question over the past year as our concept of well has changed. So it's important that we look at this and work out what being well actually means to us as individuals, but also as companies, that we consider our role in the support of this when it comes to our employees. According to Bank of Ireland, over 70% of people don't want to talk about their finances and only will do so if they really have to. It's like a taboo topic that as individuals we nearly squirm when somebody brings it up. But we need to normalise the conversation of finance. As the more we talk about it, the more educated we will become, and with that knowledge will come a sense of power. So if I asked you to sum up what financial wellness means to you, I'm pretty sure I'd get at least 20 different words back. As to define it and how it relates to everybody as individuals is very different. So some key words that sums up being financially well would mean to me would be balance, confidence, control, understanding. Now, the underlying concept of financial wellness is financial security, which is one of the most common goals in employees across all sectors. Financial well-being relates to how we manage our personal financial circumstances and balance our current income and expenses, taking into consideration our wants and needs for the future. And it's also about having financial goals and working out a clear plan on how we can achieve those goals. Financial wellness is not necessarily about how much money we have. And in fact, studies actually show that the high earners report the same level of concerns about their finances as those with more modest earnings. Because once we've satisfied our basic need and we get used to having more disposable income, our new financial status starts to nearly feel ordinary or even inadequate. So the definition of wellness encompasses a number of interdependent dimensions such as physical, intellectual, emotional, mental, social, and financial. And each of these can play a very big impact on the others. When we look back on the past year and the enormous impact COVID has had on so many, it's not one bit surprising that many individuals are overwhelmed when it comes to the concerns of their financial obligations and the security of their income. And this in turn will be having an effect on both their physical health and their mental health. Now, one of the largest insurance companies in New Ireland have noted that their COVID-related death claim payments in 2020 only actually amounted to approximately 3% of their overall claim payments. But we have seen an increase in the amount of income protection claims that are being submitted, as employees have struggled with the knock-on impacts of COVID, such as working remotely where their home environment may not be ideal, or job uncertainty or financial stress, which impacts their overall mental and physical health. Being financially well does not mean that you're immune from worry or doubt, but it just means that you have a deeper understanding of your finances, and as such, you're in a better position to deal with the unexpected. According to Bank of Ireland survey in 2019, over 1/3 of the population is stressed about money, and I'm in absolutely no doubt that that figure has gone up dramatically over the past year. Sure, if we look at household deposits, they've gone up over 15 billion since March 2020. Now, granted, there isn't anywhere to go, but as a nation, we're holding on to whatever cash we do have and part of that is down to the uncertainty about the economy. So if we look at our day-to-day expenses, most individuals have an array of different costs and outgoings. Now, for most, these are not discretionary spends, okay? These are necessities. But it's really important when reviewing your expenditures that you are firstly very honest with yourself about what you're spending your money on and also open to see how you can make changes. So when we consider your financial circumstances, we are looking to get a good grasp and understanding of your monthly commitments. Now, more often than not, when we ask somebody how much money they're spending per month on average or what their total fixed expenditures would be, you tend to be faced with a bit of a blank expression with an air of embarrassment. Now, these questions are not designed to make you feel uncomfortable, but more to highlight the fact that in order to understand and control your financial affairs, you do need to know what you're actually spending your money on. It's also about looking at protection. For example, more people have pet insurance or gadget insurance than insuring themselves. I have a cat. It costs me around 15 euros a month to insure him, okay? And I recently discovered that my husband has gadget insurance for an old iPad that I'm pretty sure gave up on us a few years ago. But this is very common. You know, we spend this money and we don't even realize that we're spending it. Now, the iPhone or the pet can be deemed more valuable than insuring one's own income. And when you actually say that out loud, it makes absolutely zero sense. And there's so many options available on how to make ourselves more tax efficient. So for example, retirement planning, where you get tax relief on contributions, or protection plans like income protection or pension term life cover, both of which give you tax relief on the premiums you pay. So for example, if you're self-employed or in what's deemed as non-pensionable employment, and you have regular life cover in place, you could consider taking out pension term life cover, which is essentially life cover, but has the added benefit of getting tax relief on the premiums. We often see clients who have mortgage protection, which they've taken out through the bank, and the bank have sold them serious illness cover as part of this cover. So it's actually about reviewing the terms and conditions of the various policies that you have to see, well, look, what am I actually covered for? And is it worth what I'm paying for? Because what you deem a serious illness and what the insurance company deal as serious illness can be very, very different. You might get a partial payment, but a full serious illness payout is very, very rare nowadays. So we'd also often refer to this type of cover as specified serious illness, as not all illnesses are covered. Now, personally, I'm not a big fan of having serious illness cover linked to the mortgage, as technically then the bank own the policy and can dictate how any claim payment would be used. However, it is worth considering whether income protection plan that gives you a monthly income in the event of claim rather than a lump sum would be more appropriate for you, as you also get tax relief on these contributions. Because if you actually think about it, if you did not have your regular income, how long would your savings actually last you? So our aim is to try and assist individuals and understand and take ownership of their financial affairs so they can be more realistic in their budget and set very clear, achievable goals. And education on how to maximize the tax credits available is key to this, because so many that we speak to aren't aware of what tax reclaims they can make, even from a medical health point of view or medical expenses point of view. So providing some guidance on the opportunities to your employees to discuss their circumstances with an advisor, whether with an internal payroll specialist or an external advisor, can really empower the employees on their benefits and affairs and really benefit their family greatly in the long run. So pension's a key area when we're talking about financial wellness, because we're all very guilty of not wanting to think about the future. And often we shy away of thinking about the retirement, as for many there is this association with old age and in turn death. But in reality, by looking at this sooner rather than later, you're going to put yourself in a far better position to be able to retire with confidence and have sufficient income, because it is the time in our lives that we want to be able to spend our time doing things we enjoy and not, counting the pennies. Now, as I said, retirement plan is something that we're all guilty of putting on the long finger. There is always something else. And I myself was guilty of it. I've worked in the pension industry for over 18 years, yet only, shall we say, seriously started pension funding within the last 5. Now, you might laugh and think, well, look, surely I'd know better, and I should. But like so many others, there's always something else. And there's that fear of judgment that we should know better. If we think of even the wonder of compound interest, and it really is the best kept secret. Because if you save €200 a month for the next 25 years, and if we assumed a growth rate of 4% per annum, that's a pot of 105,000 approximately by retirement. Now consider the fact that you get tax relief on that premium. Well, it's actually only cost you 36, but you have a pot of 105. Now, obviously, there's no guarantees with investment return and things like that. But again, it's just getting an understanding about how you're saving and is it being saved in the most appropriate manner. As I said, saving is a hot topic these days, and we all know bank deposits are miserable. So it's considering the alternate options out there, because it is not only about how you save or how much you save, but it's also about where you save it. Now this, I'm not necessarily talking about saving a large amount each month, but it's just about managing the amount that you do have to save in the way that's best for you and for your goals. So for example, if your aim is to save for a general future, or is it for a specific purpose like education costs? Or do you intend to gift money to somebody in the future towards a first home? Well, if this is the case, there are different options available to you. So such as the child savings plan, which you can avail the annual gift exemption of $3,000 per annum. Now, the annual management charge on these type of plans does vary greatly. So I would suggest that you review what you currently have if you are saving at all, and just make sure it's sufficient for you. So if we're moving on now to the pension landscape and how it has changed significantly over the past few years, and it's really important for employers to review their current plans and make sure it's competitive against the market. So things to look out for, to question would be, look, do you pay trusteeship? Because a lot of the providers now offer this as part of the overall benefits package. Do you receive 100% allocation on your contributions, or are there entry charges? Do you pay a policy fee? And what's the management charge? So just making sure you're getting value for the plan and that your members are in turn getting the value and the appropriate advice in relation to their benefits. Now, under Irish legislation, an employer is not obliged to contribute to a pension plan, but they are obliged to facilitate it. Now, we do know contributing to a retirement plan on the behalf of the employees is a tax efficient way to benefit staff, and there's loads of different options out there as to how it can be structured. Now, we know auto-enrolment is not in Ireland at the moment. There is a consultation paper in the government at present over this so that we would have a structure similar to the UK. However, it's been pushed out a couple of years, and look, now with COVID, it's hard to know when it will come in. But it is out there essentially that there is a plan for us that when we join an employment, we would automatically be enrolled in a pension scheme, and then we have the option to opt out. Now, one thing we do know is that the state pension in its current form is unsustainable, especially with the ageing population. So another area that we're seeing a lot more activity on or queries on is how COVID payments have affected claims or benefits, as they are normally linked to the salary that's received. Now, most insurers have a very flexible approach on this, and I know what we've had to do with where a couple of employers is return 2019 salaries for the renewals, because obviously salaries from 2020 or even 2021 have been significantly less where there's been company layoffs or reduction in wages. So it's really important that you engage with your advisor on this and make sure also that your insurer is aware of your circumstances, whether that's availing of government supports or having staff on layoffs or reduced working hours, because it is not a one-size-fits-all approach, and you want to make sure that your benefits are covered in the unfortunate event of a claim. There's also the consideration around remote working, and I'm more talking around where you have an employee that opts to work from a different country, whether European or not. Again, do not assume your cover will be maintained in this instance, and seek appropriate advice from your advisor to ensure that you and your employees are aware of any impact of this remote working. So IROPS 2 was transposed last week, and this directive was not actually due to be in effect until later in the year. So this last week has been a bit of a scramble, maybe to try and work out what it actually means for everyone and what is the actual timeline for this. The ultimate aim of IROPS 2 directive is to introduce an effective system of governance for the operation of pension schemes across the EU. Now, on this slide, I've summarized some of the key takeaway points, but what we do know is that this will be a positive for group scheme members, as a requirement for things like disclosure of information to members, both active and deferred, is going to increase, and essentially the governance of pension is strengthening. Now, this will likely mean additional cost to both trustees and employers for the running of the schemes, as the administrative burden will have additional duties on everybody. The supervisory function of the Pensions Authority will also be enhanced. So with that will come more scrutiny to ensure that the various stakeholders are fulfilling their regulatory obligations with the pension schemes. The directive also includes a section on investments for pension assets and restrictions, including no borrowing by occupational pension schemes, with assets having to be invested predominantly in regulated markets. This will also apply to some one-person arrangements and self-administered arrangements. Now, we are awaiting guidance and timelines in relation to the new requirements, but what we do know is that these changes will have a really big impact on the pension landscape over the next few years. So when looking at the overall benefit package, I suppose it has times have changed for employees, okay? And nowadays salary is not necessarily the be all and end all. So it's also about looking about how we can benefit staff, but in a more rounded offering, and also get some tax benefits along the way. So a benefit that can be considered, and I've mentioned this earlier, would be like things like death and service cover or income protection benefits. Now, these are not costly benefits when you actually get quotes for them, because what they do is if you have more than 3 lives, you have an average. So an average age, average salary, and average benefit role, and you're costed on that average. Now, again, risk and protection benefits are becoming nearly the norm for employers to offer for staff, and they do have the tax benefits on the premiums. So it does give you some comfort, I suppose, that you are benefiting your staff with some financial security should something happen, but it's also in a tax efficient way for you as an employer. As I've said, individuals aren't the only ones that necessarily will benefit from the whole area of financial well-being, because there is a definite increase in morale in employees who feel financially educated. Employees who understand their financial circumstances are likely to be more engaged, productive, as they do not have the financial burden or worries, I suppose, on their shoulder. The concept of financial wellness in the workplace is simple. If you aren't distracted and worried about financial problems, you are less stressed, healthier, and you will be more able to focus on work. A recent study suggested that nearly 50% of employees admitted to spending time in work dealing with their financial circumstances, and over 55% actually wanted assistance in managing their finances. It's not a one-size-fits-all approach, and it does very much depend on the company. But whether you're self-employed, an SME, or part of a large company, a workplace financial wellness program can be one of the best ways to help your employees and your organization. The right program can really help reduce stress while guiding your employees through the various financial stages of life. Now, if we look at how this can be facilitated, in essence, it can really be tailored depending on what your needs are and what your employee needs are. And we normally suggest a seminar to give an overview of the key areas. But then if we want to look at it further, I suppose you can get into the nitty-gritty of drop-in clinics, one-to-ones, and really help provide bespoke advice that can be to those who really need it to get control of their financial affairs. For those at executive level, we can go straight to a 3-step process where we essentially look at your life planning, financial planning, and then again, financial advice. So to summarize, I suppose I would really encourage everyone to get an overall review of their own personal financial circumstances, but also your corporate benefits offering. As I said, it's not necessarily about adding expense or more outlays, but actually just reviewing what you currently have in place, making sure it's cost effective and cost competitive against the market, and then empowering your employees with the tools and opportunity to get what's called financially well, because as a result, this will really impact their overall performance, and which will repay itself to you as an employer tenfold. So that's it from me. Thank you for listening, and I'm going to pass you over to my colleague, Michael.
Thank you very much, Debbie. Appreciate it. Good morning, everybody. Michael McKiernan is my name, and I work within the advisory practice in People and Change Consulting. Just thought we'd probably take you through a couple of highlights from the future of work, and wanted to start with a couple of things that we've been seeing in the market. And we all know just over a year from now, overnight, we basically have been working from home. And the question that's now coming up more and more is one question, which is, can I work from home, or am I tethered to the workplace? Hybrid models are now going to continue to persist across the pandemic as we start to come out of it, primarily in the highly educated, well-paid minority of the workforce. And as you can see on that last point there, it's broken through a lot of cultural and technological barriers that have prevented remote working in the past. And that was forced on most organizations about a year ago. But what's interesting is they're starting to see what the structural change is that is going to take place, at least for some, and we're going to cover some of that now. So I guess just a couple of things to consider, and things that we've been seeing from clients is there's key areas around environment, technical, well-being, culture, and return to work that people need to be looking at. And primarily it's starting to think about, from a remote working policies and framework perspective, what are the things that you need to be thinking about? So for example, what's the environment that somebody will be working in? What's the overall governance and oversight? Are there any regulatory obligations around things, for example, like data security or risk awareness training? And that could be something as simple as health and safety if somebody's working from a kitchen table with cords on the ground. From a technical perspective, it's around that infrastructure security, IT, working from home robustness, what type of service desk support and system monitoring exists. Simple things like all virtual meetings at the moment are fine, but what happens if your camera's not working? Typically what would happen in the office is you drop your laptop down to your IT services desk. They would take care of it whilst you were in a meeting with people. But now you might have to organize an hour or two to be able to have them come onto the system remotely and look at that. Well-being, I already mentioned the piece around the cord in the kitchen and health and safety, but also, do you have any training that you want staff to go through around working from home? What are the boundaries if people maybe have caring responsibilities at home, an older parent or potentially children? What are you doing around flexible working and support for staff? Individuals that might be living alone could potentially be struggling with the fact that they don't have a lot of contact. We've seen a lot around culture, in particular around some of the behaviors and tone from the top, how we communicate and how it aligns to organizations' vision and values. And that tone from the top could be around, people being expected to be in the office might be creating an undue pressure. Whilst at the same time, if there isn't enough contact coming from the top, are people being felt left alone and not being listened to? And then more importantly, starting to think about that return to work. What is the health and safety? What are the risks and the threats assessments? And what are some of the impact analysis you might need to be looking at? If we actually look at the moment, 20% of the workforce from some of the recent studies done say they could easily work 3 to 5 days remotely from home. So what is the impact across leadership and challenges and opportunities we have within organizations to do that? You start to think about everything from maybe car park spaces and the amount of investment organizations have made down to the different types of economies having a simple cup of coffee that brings into it. So if we start to think about what some of the challenges are from leading remote teams from home, there's the isolation piece, which we've mentioned, which is thinking about the lack of face-to-face interaction. Maybe people who are struggling from home, it might have been a bit easier to say, would you like to go for a cup of coffee when in the office, rather than bringing it up. So what we have also seen with some of the studies that have been out over the last couple of months is staff who are socially connected are 2 to 3 times more likely to maintain or improve their productivity. Remote working skills have not been taught. How we're using this Zoom, breakout rooms, whiteboards, etc., have not really been covered. So what are some of the different training around communications and collaboration even, that you might want to be looking at? And then also starting to think about what are the policies within your organization that might need to be updated? What do those start to look like, and are they aligned to the overall kind of value that employees are looking for? And that could be anything from providing employees with a remote working setup at home down to different ways to communicate and stay connected with teams. Just wanted to show one quick point here, which is this idea around what effective collaboration looks like too. And there's a behavior side of it and there's a technology side of it. And some of what we've seen from companies is there's been a huge focus on technology to making sure people are connected, but that's been at the expense of the behavior and the trust side. If there's too much on the technology and not enough on the behavior side, we start to lose the effective collaboration. If there's so much trust and allowing individuals to work on their own, but the technology is not working, it also starts to have an impact. So starting to think to make sure that we have that balance at a distance that is creating a real effective collaboration point is something you need to be thinking about. Now, just a bit of an update, and we thought it might be interesting to look at this off the back of what Debbie, Joanne, Michelle, and Amy have talked about already. These are the most requested perks at the moment we're seeing from remote workers. So a stipend for home office equipment, flexible hours, maybe working a 5-day week and a 4-day week, or potentially maybe reimbursement on certain bills. But also thinking about what the in-person team activities might be, anything from maybe a coffee in a local park to lunches, etc. Are there monthly food budgets or gift cards or deliveries? I know a lot of companies over the last couple of months have been doing everything from dinner kits to kind of painting by numbers with some Prosecco, etc. Home exercise or local gym memberships, and also that idea around the encouragement to work from anywhere in the world and travel. And we've already covered some of the implications that might have. So I guess just thinking as we look at what we want, a year ago, 20% overall of the organization from 2020 was saying, yeah, I know what my remote working policy is. What we're now finding is it's very, very, very unclear. How does it work if we're going to have certain numbers of individuals working in the office? Are we there on the same days? What's the health and safety? If I've got half the team in the office in a meeting and half the team working remotely, are there issues around data security and the use of personal devices? We've also already talked about the tax piece. There's also some questions around how you monitor employees within their own home that you need to think about as you update your working practices. So a couple of recommendations to overcome some of these challenges is to encourage hybrid working arrangements, but be thinking about and be thoughtful of how you match the work to the location of technology. Certain organizations are making certain days core days where everybody's in the office. For example, maybe a Tuesday or a Wednesday to allow face-to-face meetings and that collaboration. reorient and train staff to remote working skills, thinking about what those are, both on the technology, but also on the behavior side. How do you communicate, and what does that look like differently if you're having to do it over a computer or through Zoom? And then, as Debbie and Joanne have also alluded to, align your benefits to what matters most to staff, and then refresh your policies to make sure that it's aligned to the new reality. So we'll just stop there, and I'll hand back over to Kim, and we can take any questions.
All right, many thanks, Michael, and thanks to all my colleagues from our Employer Solutions and Global Mobility teams and for that insight into the latest workforce management issues, and I suppose from Michael as well, the opportunities in the future workplace. And my name is Kim Doyle, I'm Tax Director and Head of the Tax Knowledge Centre with Grant Thornton. So just looking at the time, we have a couple of minutes left to deal with any questions that you may have and also to pick up on any questions that have come through already. So just a reminder for everyone attending this webinar today, if you hover over at the bottom of your screen, you'll see a Q&A box, and if you just want to type in your question there, we'll do our best to answer now, or certainly we can follow up later. So I suppose just looking at the questions and the kind of common themes and what we've heard over the last couple of minutes, we've certainly heard a lot about working from home. And Michael, I know you covered out the many perks now that are on, I suppose, the employees' wish lists and what are being looked for certainly around when it comes to working from home. But just picking up on the question here, and it is certainly a common question we get from many clients as well, is around, well, you know, we're all, I suppose, in this working from home, and we are probably for the near future, but what reliefs are available? And maybe, Joanne, if I pass this to you specifically, if you can just remind us again on that tax relief that may be available for working from home.
Yeah, thanks, Kim. Yeah, I suppose we get asked this question all the time by clients and our own staff as well. So there is a payment that can be made by the employer tax-free of $320 a day. Where the employer chooses not to pay this, the employee then can go on and make a claim through their year-end tax return, and they can claim back a portion of their light and heat expenses and broadband expenses as well. And then where an employer provides employees with a home office setup type situation, there won't be any BIK on this either. So I think that probably covers that one.
Certainly it does for me, Joanne. Anyone, Michael, do you want to add anything to that, or on your side?
No, I guess that just, I think it comes down to making sure that you're clear on how you're aligning and or changing policies. I think a lot of what we're seeing with clients at the moment is there isn't clarity, and so therefore, because there isn't clarity, as they may be in a piecemeal way trying to do the best for employees, they're starting to create more confusion on what the overall piece looks like. So just being very clear based on what's coming out from guidance from government, what's coming out guidance from revenue, and then more importantly, really understanding what's important for the employees in the organization, and then bringing that into the overall policy.
Thanks very much, Michael. Just looking back to our questions that are coming through. So again, if you want to raise a question, if you maybe pop them into the Q&A box, but I see a couple here into our chat function. I've just noticed it popped up on my screen. So again, a common question, and not really maybe COVID related, but is around the whole PAYE exclusion orders. And just, I suppose, we could probably need a lot more minutes than we have available left to us, but perhaps maybe Joanne or Michelle, if you could just take this in terms of the circumstances generally where you would see a PAYE exclusion order being required. So Joanne, maybe perhaps you're nodding there.
Yeah, no problem. So yeah, generally a PAYE exclusion order can be obtained where an individual is, I suppose, being sent on assignment to another country, and the intention is that they will remain non-resident. They'll become non-resident and will remain non-resident. And there's a couple of different conditions that apply, but the main ones really are that while the exclusion order is in place, and in order for PAYE to be turned off in Ireland, they shouldn't really have any more than incidental work days in Ireland. And incidental isn't, I suppose, defined in legislation, but it's typically any more than 30 work days. So it's more, PAYE exclusion order is obtained when it's a more long-term assignment, I suppose. Generally, you'd be looking at 12 months at least.
Thanks very much, Joanne. Very comprehensive in a minute or so less. Just looking again at another question we have come through, and you can fight among yourselves as to who wants to take this one. Perhaps maybe Mike, it's for you, but is there any easy way to allow employees to work overseas for a period of time? I suppose irrespective of where they're going, but generally going overseas.
I can take this one.
You take that one, okay, sorry, apologies. Okay.
No, you're all right. From a tax perspective anyway, we get asked this question a lot as well. And I suppose the short answer is there's no easy way to advise on this, because like I mentioned in the presentation, the foreign tax implications need to be considered. So we would generally reach out to our colleagues in our network offices. I know specifically in the question there was mentioned Poland. That can be one of the more probably extreme countries, I suppose, where a payroll obligation may actually arise from day one. But again, there's different things to consider around the terms of the treaty that's in existence, and just we would always say to look for advice. And there's no, in Ireland we can kind of say that if somebody can come here for 30 days without triggering a tax liability, but we can't for certainty say that when it comes to other countries. So again, it depends kind of on the case in question. I know India was mentioned as well, and I just know that again that will depend on their residency. I suppose rules are slightly different and they look back at other years. So if the person is an Indian citizen to begin with and maybe hasn't been here for that long, they might not have actually lost residency in the first place, which could trigger an obligation. But again, all these things have to be considered, and we would always advise that the foreign advice is obtained.
Thanks, Joanne. And just going to take one more question then, just again conscious of the time, but for everyone's benefit to maybe wrap it up, is going back to the earlier presentation. I suppose we first heard from Michelle and then Amy around the COVID schemes and particularly the wage subsidy schemes. And just a quick question, perhaps Amy, you'll take this one around the TWSS reconciliation that I know Michelle highlighted, but maybe more on the payroll side, is there any where there's differences between what revenue statement is saying under the reconciliation compared to what the employer may be expecting say on their side based on their records? Is there any reason for this or anything you're coming?
Yeah, we've seen a bit of this actually. It can be the first thing to do is go back and check the reconciliation that you submitted in 2020. So Revenue did ask all TWSS employers to submit a CSV file into them prior to October of last year. So the first thing is to check to make sure that has been submitted correctly. Sometimes we're seeing that the line item ID was incorrect on what was submitted by the employer or something as simple as that. And it can be easily rectified by uploading a new reconciliation to correct that issue. Another issue we're seeing is particularly around Sage software users. Back in April, Sage hadn't updated the software in line with the TWSS, and some of the submissions went through to Revenue, including the subsidy and gross pay, which was incorrect, and it's resulted then in us showing that the full subsidy for April is due back. So there is, again, just linking with Revenue on this, there is an easy fix for that to get that updated, and it will correct the subsidy balance due.
Thanks very much, Amy. Michelle, is there anything you wish to add, or not putting you on the spot just before we close?
No, maybe not on that particular point. Just to stick with the TWSS and the compliance check that was underway, I didn't really touch on that in the presentation, but if anyone hasn't engaged with Revenue to date on the compliance check, typically there was a 5-day turnaround for engagement with Revenue, and employers would have received a letter of compliance from Revenue at this stage. If they haven't engaged, Revenue are reaching out to those employers, and there will be a deadline put on engagement for the 17th of May this year. It's vitally important that employers engage with Revenue on the TWSS compliance check if they haven't done so already.
Thanks very much, Michelle, for that reminder. So again, just looking at the time, I think we'll wrap it up there unless any of my colleagues wish to add anything. Debbie, Michael, Amy, Joanne, or Michelle, is there anything you wish to add at the end or highlight? No? Okay, well then all that's left for me to say is thank you very much again to all my colleagues and for your attendance as well virtually. A copy of the, sorry, yeah. Sorry, I thought I heard something there. A copy of the slide will be made available and circulate to you, and a copy of the recording as well. So just take care everyone and have a good day.